Hi friends, we are back with our monthly fixed income outlook series. What we'll cover today is the major events for the month, the impact of the same on markets, our outlook, the portfolio strategy, the risk to the view, and what should investors do. The month started with a weaker than expected election results, which led to volatility in bond market yields. We actually saw a 10 bips rise in bond yields on the election result day, but most of it got reversed over the month. Another major event for the month was RBI policy, which was the status quo on RBI rates, and RBI continued its cautious stance on inflation. There were no significant revisions in any of their macro projections. Large global central banks have started to pivot on the rate cycle. ECB, Swiss Central Bank, Bank of Canada all delivered a rate cut and guided for further rate cuts due to the falling inflation trajectory. US macro data continued its weaker trend. Q2 data was substantially weaker as compared to Q1. Retail sales, employment, inflation data all came weaker than market expectations. The worry as per me is that US government continues to expand its fiscal. For 2024, again, its fiscal deficit is expected to rise to 6.8% of GDP as against 6.3% previously expected. Coming back to India, banking liquidity still continues to remain in deficit zone due to lack of government spending. Government is running a huge balance of more than 5 trillion, and we believe that scheduled GSEC maturities and accelerated spending will improve banking liquidity from July. Headline CPI in India came at 4.75. Both headline and core inflation came a tad softer than expected, and unless we see any surprises from monsoon, we don't expect any upside in the CPI trajectory in the near term. OPEC extended their cut, which led to a rise in Brent prices by over 5%. Other commodities, especially base metals, lost shine last month because most of them corrected by 2 to 5% on account of weaker than anticipated China data. Finally, Indian government bonds got included in JP Morgan indices from 28 June, and we should expect 50 to 20 billion of flows till March 2025. What was the impact of all the events on our markets? Bond markets traded in a very narrow range for the month of June. Yields across the curve, both short and long end, did not move significantly on either side. With continued FPI debt flows and accelerated spending in July, we expect bond yields to trend lower. All eyes in July would be on the budget, and we don't expect any major moves before the budget. We believe that government would continue with its path to fiscal consolidation, focus on infrastructure and policy continuity in this budget. We also expect government to stick with its 5.1% fiscal deficit target for the year and use the buffer 0.3% of the GDP created due to excess RBI dividend on additional welfare and capex spending. Both US and Indian markets today still don't price any significant rate cuts till December 2024. And we also don't expect any rate cuts immediately. What's the strategy for our portfolio and outlook for markets? Strong growth and high frequency indicators, which are coming very strong, and monsoon uncertainty right now will keep RBI cautious, and we don't expect RBI to be in any hurry to cut rates. Higher than anticipated US fiscal deficit would also keep US yields trade in a range despite soft US macro data. Our core view continues to remain constructive on rates due to the positive demand supply dynamics, especially for the Indian government bonds, lower CPI, and the stable external sector outlook. We expect a 50 basis of rate cut in the next 12 to 18 months in this rate cut cycle. In anticipation of continued FPI flows in government bonds due to JP Morgan inclusion and expectation of improvement in banking liquidity, our portfolio allocation has tilted towards a higher government bonds and 1 to 3 year corporate bonds. Risk to the view. The market positioning today is very heavy, both for traders and investors, which means everyone is positioned for rally in bonds. Any surprises on borrowing in the budget, like additional borrowing, can lead to volatility and rise in yields by 10-20 basis. What should investors do? Investors should continue to hold their duration across their portfolios. Investors but need to understand that they would have to be patient for further rally as further rate cuts and easing would be delayed to the second half of this financial year. With expectations of lower CPI, no change in the fiscal deficit and borrowing in the budget, and continued flows from FPI, we continue to advise short to medium term funds build tactical allocations to gilt funds to our clients. Keep watching this space for more fixed income outlooks. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.